For decades, global markets treated Japan like a financial exception to every rule. The country carried the highest sovereign debt load of any advanced economy, towering near to 130% of its GDP. Yet its bond yields remained frozen, its currency stable, and its economy seemingly immune to the gravitational pull of basic economics. Traders joked about the Japanese anomaly, a place where debt didn't matter, inflation never rose, and crisis always stayed hypothetical. But this autumn, the illusion finally cracked. It happened quietly at first, almost imperceptibly, a slight tremor in Japan's bond market. A headline out of Tokyo that didn't fit the old pattern. A sudden flicker of volatility in a market that had been sedated for nearly a generation. Then the tremor became a quake. Investors who had long dismissed Japan's debt burden as harmless suddenly found themselves staring at a reality they had refused to believe for years. Japan might no longer be able to defy financial gravity. For decades, the world had comforted itself with the belief that Japan was different culture, different demographics, different monetary framework, a place where rules bent but never snapped. But that belief evaporated almost overnight with the arrival of a new prime minister, one determined to rewrite Japan's economic narrative not with caution, but with force. The first cracks appeared in the bond market, then the currency shuddered. Then global investors finally realized what they were looking at, not an anomaly, but a time bomb that had begun ticking loudly, unmistakably, and in full view of the entire world. Japan was no longer the safe corner of global finance. It had become the epicenter of the next possible crisis. 6 weeks after taking office, Prime Minister Sanae Takayichi detonated the first shockwave. Her administration revealed a $135 billion stimulus package, a package so politically loaded and economically reckless that even longtime Japan observers were stunned. This wasn't strategic spending. This wasn't targeted investment. It was a fiscal storm filled with giveaways that seemed designed not to strengthen the economy, but to conceal the inflationary fire. Japan had spent years trying to suppress rice vouchers, fossil fuel subsidies, direct cash injections to households. On paper, it was called stimulus. In practice, it felt more like political anesthesia, a desperate attempt to numb the public to the consequences of the government's own policies. Japan had spent decades fighting deflation, but now, just as inflation finally returned, its new leadership was pouring kerosene on a flame they barely understood. Within minutes of the announcement, markets reacted violently. Years of suppressed volatility came bursting to the surface, as if someone had lifted the lid off a pressure cooker that had been sealed since the late 1990s. The Japanese 10-year government bond, which had barely twitched for decades, spiked toward 1.9%, the level not seen since 1997. It was a minor number for any normal country, but Japan was not normal. Japan had built an entire financial architecture on the assumption that interest rates would never rise meaningfully again. Even a small increase had catastrophic implications, threatening to unleash a chain reaction through its enormous debt mountain. Economists inside Japan began sounding alarms none of them ever expected to repeat. A Liz Truss-style meltdown, the kind that nearly dismantled the British bond market in 2022, was no longer hypothetical. It was a scenario being openly discussed in Tokyo. Debt service costs were already rising. Takayichi's spending surge turned a dangerous trend into a potentially lethal one. Tokyo's political theater was now colliding headfirst with mathematical reality, and the world was watching. The consequences of Takayichi's fiscal eruption arrived faster than even her critics expected. Japan's bond market, once the most stable in the world, started behaving like an emerging market. Under stress, the Bank of Japan could no longer cap yields without risking an outright collapse in the yen. Traders sensed blood in the water as yields drifted upward. Tokyo faced a nightmare scenario. The cost of servicing its debt, already massive, began to surge. Analysts had warned for years that Japan's bond market was a dormant dragon. In late 2023, the dragon finally opened an eye. The spike in yields was small by global standards, but devastating for Japan. A nation addicted to ultra-low rates could not survive a world where borrowing costs behaved normally. For decades, Japan had been the quiet giant of international finance, the world's largest external creditor, and the most predictable buyer of U.S. Treasuries. But those days were fading. If Japan's bond market spiral continued, the consequences would not stop at its borders. They would hit Wall Street, Washington, Beijing, and Europe, because Japan was not just another country. Japan was an anchor, and anchors are not supposed to move. When they do, ships drift into storms. Inside Tokyo, fears began circulating through ministries and banks. What if confidence breaks? What if the bond market loses faith? What if investors start fleeing the yen? What if Japan, the country that spent 30 years as the world's stabilizer, became the world's greatest financial liability? The questions were no longer academic. They were urgent. For more than a generation, the yen served as one of the world's most reliable financial instincts. Whenever global markets panicked, when oil prices spiked, when banks collapsed, when geopolitical tensions exploded, the yen strengthened. It was viewed as a currency immune to chaos, anchored by Japan's enormous foreign asset position and the disciplined saving habits of households and institutions. Whenever fear gripped the world, Japanese capital flowed homeward, and the yen surged like a reflex conditioned by decades of stability. But under Prime Minister Takayichi's fiscal eruption, the yen has begun to behave like a currency stripping away its old identity. Instead of rising during global uncertainty, it has been sinking with unnerving consistency, hovering near 155 yen to the dollar, its weakest level in half a century. This is not simply a market fluctuation. It is a breach of character. A currency that once signaled strength is now revealing fragility, and investors who once relied on its stability are beginning to question whether the yen's safe haven status was always more myth than reality. The yen slide reflects something deeper, a global reassessment of Japan's policy direction. Takayichi's spending programs, financed with debt and delivered without clear reforms, have convinced markets that Japan is no longer acting like a disciplined steward of its currency. The yen is no longer protected by the psychological force of credibility. As markets lose confidence, the yen falls not because of momentary stresses, but because investors increasingly believe that Japan lacks the willingness or perhaps the ability to correct course. This transformation carries profound consequences. If the yen can no longer attract capital during periods of global fear, the world loses one of its key stabilizing anchors. For 30 years, the yen absorbed shocks that might otherwise have destabilized markets. It cushioned global liquidity and provided refuge for investors fleeing volatility. But now, instead of rising when the world trembles, the yen behaves like a vulnerable emerging market currency, hypersensitive to shifts in interest rates, fragile under the weight of political missteps, and increasingly exposed to external pressure. Should markets lose confidence entirely, Japan could face an unprecedented reversal: capital fleeing the country during global stress rather than returning to it. Such a reversal would deepen the yen's decline, forcing Japan's leadership into an impossible situation. If they raise interest rates to support the currency, they risk annihilating their debt-laden fiscal structure. If they keep rates low, the yen spirals downward. And if they attempt to print more money to stabilize the system, they risk igniting the very inflation they have spent decades trying to avoid. Japan now stands inside a tightening vice, caught between defending its currency, defending its bond market, and defending its economy. It cannot protect all three. The world is only beginning to absorb the implications of this reality. What once seemed unshakable is beginning to quake, and the early tremors are already spreading beyond Japan's borders. 4 years, Japan managed to sustain a national debt that would have crippled any other advanced economy. Analysts marveled at how a country could carry liabilities exceeding 230% of its GDP, and yet remain functional, stable, and even serene in its economic rhythm. Its secret lay in the near-zero interest rate environment that persisted for nearly an entire generation. As long as borrowing was essentially free, the size of Japan's debt was a curiosity rather than a catastrophe. That delicate balance has now been shattered. With inflation finally returning to Japan and yields rising accordingly, the mathematics of debt has begun to reveal its unforgiving nature. For 40 years, Japan's annual interest bill hovered around 10 trillion yen, even as debt ballooned. But this stability depended on ultra-cheap financing. As older bonds mature and must be refinanced at higher yields, the cost of servicing Japan's enormous debt pile rises dramatically. The IMF expects interest payments to double by 2030. By 2036, they may quadruple. These projections assume calm markets and orderly refinancing. But crises do not respect orderliness. As the yen weakens and bond yields climb, the scenario becomes more precarious. Japan may soon face fiscal decisions that have not been contemplated since the desperate stabilization efforts that followed World War II. Experts quietly warn that the government could be forced into measures that modern democracies consider taboo: sudden tax surcharges, forced conversions of private assets into government bonds, or even temporary freezes on certain classes of bank deposits to stem capital flight. While such outcomes may seem extreme, they are not unprecedented. They represent the last resort tools used when a nation's fiscal structure collides with demographic decline, stagnating growth, and the rising cost of social welfare. Japan's shrinking workforce and aging population are not temporary challenges but permanent structural shifts. They push spending higher while reducing the base of taxpayers who can sustain it. Without meaningful reforms that Japan's political leadership has been unwilling to pursue the debt burden becomes heavier each year. What makes Japan's situation particularly alarming is that it now faces rising interest rates and rising debt simultaneously. This combination is economically lethal. A debt mountain that once seemed manageable transforms into a force that grows independent of policy intention, feeding on itself as refinancing becomes increasingly expensive. In such an environment, even competent leadership struggles. Under political missteps, the danger compounds. Japan is learning the lesson that every highly indebted nation eventually confronts. Debt is manageable until suddenly it is not. Once interest payments begin their upward climb, once the demographic base erodes, and once confidence wanes, the system shifts from stable to unstable with astonishing speed. And because Japan is not an isolated participant in the global economy, but one of its central pillars, the consequences of its fiscal unraveling will reverberate far beyond its shores. Japan's crisis does not exist in a vacuum. It emerges at a moment when the world's major economic powers are each struggling with unprecedented debt burdens. In the United States, federal debt now exceeds 125% of GDP, and interest payments are rising faster than spending on defense or social programs. China, once the engine of global growth, is battling a slow-motion collapse in its property sector, a sector so large it represents one of the primary storehouses of household wealth. Europe remains tethered to a monetary framework that has allowed its member states to sustain nearly 95% debt to GDP ratios only through years of artificially suppressed interest rates. Together, Japan, the United States, China, and Europe hold the majority of the world's sovereign debt. They represent the core of global finance, and their stability underpins the security of markets, currencies, and institutional trust. When the foundations of these regions begin to crack simultaneously, the entire world feels the strain. Central banks are maintaining elevated interest rates to combat inflation, forcing governments to pay more to service their existing debt. As this burden grows, they have less capacity to fund public services, invest in infrastructure, or stimulate the economy during downturns. The consequence is a world in which economic resilience wears thin, where fiscal ammunition is depleted, and where political tensions intensify as citizens confront the slow erosion of living standards. The situation is even worse in developing nations. According to the United Nations, more than 3.3 billion people now live in countries where governments spend more on interest payments than on healthcare or education. This is not the distant future of global finance, it is its present reality. And the same trajectory now awaits advanced economies as their debt continues to climb unchecked. Total global debt has reached a record-shattering $337 trillion. This figure represents not an abstract statistic, but a measure of the fragility within the world's financial architecture. Sovereign bond issuance is hitting new highs each year, and the appetite of investors to absorb this supply is shrinking. Markets have grown more volatile, more interconnected, and more prone to sudden shock. A crisis in one major economy, especially one as central as Japan, can now ricochet through the entire system. If Japan's bond market unravels or if its currency enters free fall, the United States will feel the shock through treasury markets, Europe through banking channels, China through trade flows, and the rest of the world through rising borrowing cost. Japan was long considered a stabilizer of global finance, a quiet giant whose predictable policies absorbed instability. But as that reliability fades, the world is entering a period where the margin for error is smaller than ever before. Japan's crisis marks the first major test of this new era, a time when high debt and high interest rates converge across all major economies. The global system has never experienced a storm like this, and its outcomes are impossible to contain within national boundaries. What unfolds in Tokyo will not stay in Tokyo. It will define the next chapter of global economics, whether we are prepared for it or not. If Japan were merely a troubled economy on the fringes of global influence, its crisis would be containable. But Japan is not a fringe nation. It is the world's third largest economy, the largest foreign holder of U.S. Treasuries, the central anchor of Asian trade, and the quiet stabilizer of global finance for more than 3 decades. When such a nation begins to wobble, the consequences do not remain regional. They propagate outward, like fractures running through the foundation of a house that was assumed to be indestructible. The scenario begins the moment markets lose confidence in Tokyo's fiscal discipline. Bond yields rise faster than policymakers can respond, pushing the cost of refinancing Japan's colossal debt toward levels that would make even small European economies shudder. The Bank of Japan faces an impossible choice: defend the currency by raising interest rates or defend the bond market by suppressing yields. Both cannot be done at once. In choosing either path, Japan destabilizes something essential: its currency, its debt market, or its banking sector. As the yen spirals downward, Foreign investors begin to offload Japanese assets. Pension funds, sovereign wealth funds, and global banks no longer see the currency as a refuge but as a liability. Portfolio managers panic, selling Japanese bonds in volumes never before witnessed. Their exit accelerates the fall of the yen, pushing it past levels once thought impossible: 160, 170, 180 per dollar. A currency crisis, once considered unthinkable for an advanced nation, becomes a visceral, immediate reality. But the collapse does not stop there. Japanese institutions, desperate to defend their balance sheets, begin liquidating what they can: foreign assets, mostly U.S. Treasuries. After all, Japan is Washington's largest creditor. The moment Tokyo becomes a forced seller, the U.S. bond market feels the tremor. Treasury yields spike unexpectedly, sending shockwaves through global risk markets. Mortgage rates climb, corporate borrowing costs surge. The U.S. financial system, already strained by its own rising debt burden, begins to crack under the pressure of higher yields imposed by events in Tokyo. China, watching this unfold, finds itself caught in a paradox. A weakened Japan undermines regional stability, yet Chinese markets are in no position to absorb the shock. China's local governments are drowning in hidden liabilities, and the property sector, the engine of China's wealth creation for decades, is imploding under its own weight. If Japan collapses, Chinese capital flees not toward Beijing but outward, toward the dollar, ironically strengthening the very currency the United States is struggling to maintain. In this way, crisis becomes circular, feeding on itself. Europe is no safer. Italy, France, and even Germany have sustained their debt loads only through a decade of artificially suppressed interest rates. If Japan's crisis sparks a global flight from sovereign debt, European yields begin to rise in sympathy. A shock in Tokyo becomes a tremor in Frankfurt, which becomes a quake in Rome. Suddenly, the euro area, the world's second largest economic bloc, is fighting its own bond revolt. In markets worldwide, money begins to behave erratically. Safe havens stop acting safe. Correlations break. Rules once believed ironclad dissolve under the weight of cascading sell-offs. Investors rush not toward opportunity, but toward survival, even if survival means accepting losses that would have been unthinkable only months before. Japan's collapse does not appear as a single dramatic explosion. It unfolds as a chain reaction, a series of smaller detonations that accumulate into something far larger than the sum of their parts. The effect is not simply financial, but psychological. A realization begins to spread across markets, governments, and institutions. If Japan can fail, anyone can. The myth of the too advanced to collapse economy evaporates. A new, darker understanding takes its place. The world is entering an era where debt levels are no longer theoretical concerns, but active threats, where the mathematics of sovereign finance, ignored for years, demands to be acknowledged. Japan is simply the first pillar to crack. But in its cracking, it exposes the fragility of an entire global system built on perpetual borrowing, political denial, and the belief that central banks can indefinitely suspend the consequences of fiscal excess. Once that illusion breaks, no government, no matter how wealthy, how powerful, or how central to global finance, remains immune. The unfolding Japanese crisis forces the world to confront a truth it has avoided for decades. Our financial order is not a stable architecture, but a delicate equilibrium held together by confidence, habit, and narratives of permanence. Japan's experiment in extreme indebtedness was long seen as a curiosity, a puzzle for economists, but a threat to no one. Its crisis, however, shows that even the most advanced nations eventually collide with the mathematical and psychological limits of debt. Japan's unraveling is not a local tragedy. It is a revelation, a mirror reflecting the vulnerabilities of every debt-saturated economy on Earth. For years, policymakers reassured the public that modern finance had outgrown the catastrophes of the past. Interest rates would stay low, inflation would remain tame, debt, no matter how large, could always be rolled over. Growth could be engineered with stimulus, crises could be tamed with liquidity, and above all, the global system was robust enough to withstand any shock. But the Japanese crisis reveals the fragility behind those reassurances. It exposes the illusion that debt can grow indefinitely without consequence. It shows that even the most sophisticated central banks cannot indefinitely defy the physics of financial systems. When interest rates rise and trust evaporates, the accumulated weight of decades becomes unbearable. Japan's reckoning forces us to consider deeper questions many governments prefer not to ask. What happens when nations can no longer afford the cost of their own debts? What happens when demographic decline undermines economic potential? What happens when inflation destroys the political space for monetary rescue? What happens when the very mechanisms that once stabilized the world's safe haven currencies, global capital flows, and sovereign bond markets stop functioning as expected. These are not theoretical musings. They are the realities Japan now confronts. And they are the realities the United States, Europe, and China will soon face as well. The era of plentiful money is ending. The era of painful arithmetic is beginning. In this new world, the margin for error is shrinking. Governments no longer have the flexibility they once enjoyed. Financial markets no longer respond predictably to rescue measures. Every policy error, every ill-timed stimulus, every reckless expansion, every refusal to confront debt becomes magnified by global conditions. Japan is discovering this now, and the world will discover it soon. Yet there is a deeper lesson beneath the crisis. Japan teaches us that financial systems are not destroyed by single events, but by the gradual erosion of trust. Once confidence breaks, once depositors doubt, once bondholders hesitate, once currencies falter, the downward spiral becomes self-reinforcing. Fiscal expertise becomes irrelevant, central bank tools become blunt, political assurances become meaningless. The collapse is not merely economic, it is psychological. And this, ultimately, is the most sobering truth Japan's crisis reveals. The strength of modern economies does not lie in their GDP, their central banks, or their fiscal machinery. It lies in the belief that the system still works. When that belief fades, the system falters, and once it falters, rebuilding trust becomes a generational task. Japan's crisis is the first major test of whether the world is prepared for an age where debt can no longer be ignored, where interest rates cannot be suppressed forever, and where the assumptions underpinning global finance are overturning before our eyes. It is the opening chapter in a story that will define the coming decades. In the end, the Japanese crisis is not just about Japan. It is about all of us, our expectations, our illusions, and our willingness to confront the reality that the global financial order is entering a new and uncertain era. The world stood on the shoulders of a system that seemed unbreakable. Now it watches as the first crack spread, and the question that hangs over every investor, every government, and every citizen is no longer whether Japan can survive the fall, but whether the world can survive what comes after.